So,
hi,
good morning,
James.
Joe. Thanks very much for doing this. AVI Japan's one of my sort of favourite funds. It's always doing something a bit different, but there's always a story to tell. You've got quite a big team working on this, which are up here now. It's much bigger than I think when it started. You want to tell us a little bit about what the fund's trying to do, please?
Yeah, sure. Thanks for having me back. So by way of background, AJOT, or AVI Japan Opportunity Trust, is about £165 million of assets. It was launched just over 4 years ago, at the beginning of October 2018. And the idea really was to take advantage of two related facts, or two related things that we could see in Japan. The first was there were a large number of companies, good quality operating businesses, that had accumulated huge amounts of surplus net cash on the balance sheet. And for many years, that cash had sat idly, earning no return, doing nothing for the economy or for shareholders, which meant that valuations in these companies were very attractive, typically low single-digit earnings multiples. And at the same time, we had, during the early years of the late Prime Minister Abe's rule in Japan, we had Abenomics, the three arrows of Abenomics. The first two were monetary and fiscal stimulus, and the third was more about structural reform. And included in that was a host of measures focused on generating and boosting shareholder returns, including the introduction of a corporate governance code and stewardship code. And the corporate governance code was very focused on getting cash off balance sheets and put into productive use. And the stewardship code was aimed at encouraging shareholders to engage with management and try and get them to focus on generating higher returns on equity and higher share prices. So we had this opportunity, we felt, to take advantage of low valuations that had existed for many years, but now we had a catalyst in the form of the corporate governance code and stewardship code to take advantage of that. So that's why we launched AVI Japan Opportunity Trust. And really at the heart of what it is we're trying to do is identify good quality businesses and actively and constructively engage with the management of those businesses to try and get them to change their policies, change their strategies in order to deliver higher shareholder returns.
Cool. And then when this slide kind of sums it up, really, what we're trying to do. But maybe we should look at the returns actually, because I think this is what's so impressive, really, that you've been managing to outperform the competition and the market by quite some margin.
Yeah, look, when we launched back in 2018, we were in the midst of a global market that was driven and dominated by high growth stocks. And a lot of our peers were focused more on growth stocks than value. This is a more value biased strategy, I would say. As I said at the introduction, all of our companies have huge amounts of net cash on the balance sheet. Roughly half the market cap in aggregate of our portfolio companies is sitting in cash. And then on top of that, they have liquid securities on top of that as well. So during the 2020 COVID year and during the more challenging environment that we've seen over the past 9 to 12 months, our companies have demonstrated the attractions of having a very strong, resilient balance sheet coupled with strong and resilient business models. And finally, the other attraction is that there's no debating or denying the attractiveness of the valuations. If you're starting at a valuation multiple of 3, 4, 5 times earnings, that's undeniably cheap. If you're starting at 20, it doesn't really matter whether it was 30 a year ago or 40, 20 could still be a high multiple to be paying. So the fact that we've been identifying these anomalies, these inefficiencies amongst good quality business in Japan, I think has served as well.
Maybe if I flick forward a couple, just have a look at this one. So this is the sort of looking at the valuations of your stocks relative to the MSCI Japan Small Cap. Mm-hmm. So how do you go about finding out identifying these companies? How do you go about identifying these companies, the ones with the cash and the securities, and then working out what those securities might be worth?
Yeah. Okay, so there are a few different stages in the process. As you would have picked up, the starting point is focusing on companies with too much cash on the balance sheet, because that's where the greatest valuation inefficiency exists in Japan. So the Japanese stock market is made up of roughly 4,000 listed companies, ranging in size from those probably below 20 million pounds to those more than 20 billion pounds. So it's a big group of companies. And the first stage of our selection process is to weed out companies that don't have what we would call substantial surplus net cash on the balance sheet. So roughly 30% of market cap, cash to market cap ratio would be a cutoff for us. And that filters out hundreds, if not thousands of potential companies that exist in Japan. At the same time, we're looking for companies that we can realistically invest in. So if a company's 20 million pound market cap, that's probably a little bit too small. And from a valuation perspective, it's the small and mid cap universe that throws up the greatest number of opportunities. So we can weed out a lot of the larger cap companies. We're also interested in avoiding value traps or zombie companies. So companies in Japan, that there are a good number of examples of businesses that don't make profits, that are highly cyclical, that are poor quality businesses, but they continue to exist and they continue to be able to pay salaries and pensions to employees and past employees by virtue of the huge amounts of cash that they've got on the balance sheet. So we're trying to filter out inferior quality companies and leave us with a universe of businesses that have shown resilience over an extended period of time and the ability to grow their profits over time. And now that takes us down to a much more manageable universe, a couple of 100 companies. And then it's a lot more qualitative analysis, understanding the businesses that they're in, whether they're attractive, whether we can look forward to structural growth in those businesses or structural decline. And then also looking at the shareholder registers of these companies, because a big part of our investment theses is built around constructive engagement with management. And oftentimes we would look to other shareholders to back us up, to support what we're saying, to say similar things to shareholders. And specifically, we want to avoid having too many situations where shareholder registers are dominated by other shareholders with a vested interest. So typically cross-shareholding arrangements that they have in Japan, which are designed to keep people like us away from management and protect them. So those are the kind of things we want to avoid. And that then takes us down to probably sub-100 universe. And from there, we want to build a portfolio that's quite concentrated. Although there are 25 companies in the portfolio, I would say that probably around 15 are core holdings where we're involved in intense engagement with the companies. We've built a position, we're maintaining or growing that position and are engaging with management on a regular basis in the pursuit of higher shareholder returns. And that's why you alluded to earlier that the larger team, the team has grown quite substantially since we launched. And that's a reflection of the intensity of the engagement process involved in running this portfolio.
Got a couple of slides on engagement. Let's have a look at those. So this is the public engagement one first. So
yeah. Well,
how often do you actually go public with your proposals? And
well, the first thing to say is that it's always our preference to keep the engagement private, because that's where you can develop the most constructive relationship with management. It's fair to say that management in Japan can be distrusting of foreign investors, and they can view our motives as being much more short-term driven than perhaps their longer-term objectives, and that creates a bit of tension. So if you can keep the dialogue constructive and friendly and supportive, you can demonstrate that you're a long-term shareholder and you want similar things to what they want, and you're not just focused on making a quick buck, then that can be quite helpful. But having said that, there are situations where we've been shareholders for a number of years, we're hitting a brick wall, management are resisting what we're suggesting, they're not changing, and that forces us to go public. But as I say, we would only go public after a number of years of attempting engagement with companies. So we do go public, and we go public in a number of different ways. The first is simply submitting shareholder resolutions to the AGMs. Not many are submitted, but it is growing in number over the last few years. So we would submit resolutions either to do with capital allocation policies, corporate governance measures, such as sort of corporate structure. We could suggest share buybacks. We could also push for more independent directors to be nominated on the board, those kind of things. And we can also go public in a more constructive way, as we've done in the case of Daibaru there and Fujitech, where we publish public presentations detailing our arguments, why the company is undervalued and what the company should do to remedy that. And that really helps facilitate a dialogue between not only us and management, but also between other shareholders and management. And it's viewed as quite constructive.
How much of a company do you need to own to get a result?
Well, the interesting thing about Japan is that you can submit a shareholder resolution if you've owned 1% of a company for a minimum of 6 months. So that gives us a seat at the table. Once you get to 5%, your stake is publicly disclosed. And I think that's a useful threshold to get to. 1% is probably seen as not a serious stake, but 5% would be seen as a serious stake. And we have a couple of situations where we are high teens, if not 20% shareholders in companies, and that really does get boards listening to us.
And how long do you think you tend to hold a company for?
It's very hard to say. Clearly, these companies are cheap, and there are a lot of potential catalysts brewing beneath the surface that could unlock value. The timing is uncertain. Sometimes it happens quickly, and sometimes we have to be more patient. In terms of our own time horizon, if we're investing in a situation where we think a company is undervalued and there's a number of things we need to engage on, we would give it a minimum of 3 years before we could tell whether we're having any success. So you need to go through, I think, 3 AGM cycles before you can be certain. But encouragingly, over the last couple of years, we've had a number of situations where we are the largest shareholder, and we've involved in quite regular and intense discussion with companies, and they're doing what we say, and they've been rewarded with a higher share price, and that's sort of ongoing, and we can own these companies for a long time.
We've got some stock examples. I had the one that you gave me first, I think, was DTS. So let's have a look at that one. So, which is I think one of the larger investments, isn't it, in the fund? Yeah,
it's certainly our largest or second largest right now. So DTS is an IT consultancy, and interestingly, in Japan, it's common for companies not to have internal IT departments, and a lot of their IT functions are outsourced to some of the companies that you see here on the graph, of which DTS forms part. DTS is one of the smaller operators. It was trading when we became interested in it a couple of years ago at a much lower valuation multiple than its peers. Back then, it was probably at 6.5 times earnings compared to the 13 or 14 times that most of its peers traded at. And that discounted valuation was a function of a couple of factors. It had cash on the balance sheet, which depressed its valuation, whereas the peers did not have any cash on the balance sheet for the most part. And also, its IR communication quality was poor. It was misunderstood by investors, and there was a sense that it wasn't as exposed as some of its peers to the higher margin digital transformation cloud work that some of the peers were trading at. So we became the largest shareholder. We set a number of different targets and hurdles for the company to meet over a 3-year period. The discussions are very constructive. We've helped them design some IR material, which has seen a greater understanding and a greater effectiveness in their communication to the market generally. And they've been rewarded by a higher share price and a higher rating importantly, that's narrowed the gap between it and its peers. It still trades at a discount, and that's a work in progress, but it's certainly moved in the right direction. So it's a good example of a situation where not only has the engagement worked, but we've been accompanied by a rising share price and strong investment returns.
It's interesting because it's not even in a sort of sector that you'd think of as being value.
That's right. That's right. And I think that's a pattern that we're finding increasingly common in Japan, where we've been able to position ourselves in sectors or companies that are perceived to be more growthy than sort of boring old economy values sectors. But they're trading at very, very attractive valuations.
Good. Okay. There's a question about Fujitech. I think somebody's been reading our note. Let's bring up the slide for that one. Let's you can find it. There we go. So, I mean, the question's about the situation with the Sun's founder. Did you see this coming? Is the question. But maybe you can sort of give us the background to this and why it's been a good investment for the fund so far.
Okay. Okay, so very briefly, the background, similar to GTS, I would say, there was a very, very clear valuation discount between Fujitech and its global peers. The global elevator and escalator sector, of which Fujitech is one of the top 10 players, had seen a lot of corporate activity over the past 6 or 7 years, I would say. And much of that activity was occurring at valuations of around 20 times EV/EBIT multiples. And the reason why the sector was seen to be attractive was once a company had installed an elevator or an escalator, which was a profitable business, but not massively so, they could look forward to the very attractive and resilient cash flows from maintenance contracts and upgrade contracts. Now, Fujitech wasn't quite as profitable as most of its global peers, but it wasn't a long way off. And the difference in profitability didn't justify the valuation discount that you can see on the graph here back in May 2020, when Fujitech was trading at 6 or 7 times earnings multiples, whereas the peers were trading closer to 20. So again, Fujitech had roughly half its market cap in cash, and that leads to a depressed valuation for a start. On top of that, it had some corporate governance concerns. Notably, it had put in place 10 or 15 years ago, a poison pill that allowed it to dilute any unwanted shareholder on the register pretty substantially. And that had deterred any form of potential corporate activity, any interest from other industry players or private equity investors as well. So we took a stake, we worked with management, we published a public presentation arguing the company was very cheap and that it should pursue better standards of corporate governance, it should pursue better capital allocation by doing more productive things with its cash, and it should do away with the poison pill. And on top of that, there were various operational and strategic initiatives that we suggested the company ought to pursue in order to generate higher returns for its shareholders. The company responded by implementing a strategic review. They agreed to do away with the poison pill, which is a great result. They've come up with much more transparency and objectives, clear objectives on what they want to do in terms of capital allocation. All of that was accompanied by a rising share price as investors started to recognize that management were going to be much more shareholder friendly and returns were going to go up. So it's been a successful investment. So the question around the founder's son relates to events leading up to the AGM that took place in June this year. The background is that Oasis, a Hong Kong-based hedge fund, have taken a large stake. And as part of their investigation into the company or analysis of the company, they investigated the activities of the founder's son, who was president, I think, up until the AGM, and unearthed a number of transactions that took place between his private entities and his family and the public company, including use of transactions involving some central Tokyo real estate, use of company assets whilst not paying for them, and such transactions effectively. As a result of that, the Oasis led a big push from shareholders to not vote for the president at the AGM in June. And in Japan, if an officer of the company doesn't get 50% support, that they can't remain on the board. So what happened in this case was that half an hour prior to the AGM, the president announced that he would not be standing for re-election and would stand down as president. So we never discovered how many shareholders voted against him, but the foreign ownership of Fujitec is close to 50%. And we've seen over the last few years that a number of Japanese domestic asset managers typically vote and think in the same way as us foreign shareholders. So the chances are he would have been hugely embarrassed by the lack of support and may have found his position untenable. So he stood down. Half an hour after the AGM, he appointed himself as non-executive chairman. So it's not a formal board position, but he's sort of back sitting in the board meetings and exerting control and influence, and certainly greater control and influence than his shareholding in the company justifies. So it's been a bit of a corporate governance disaster, I would say, for the company, an example of poor corporate governance. Where we are at the moment is that the foreign ownership is going up. Oasis still have their stake. We have our stake, and others have been building more stakes. It seems that the company is undergoing an internal second investigation into the acts of the president stroke chairman, and we await the results of that second investigation, because the first was a bit of a whitewash, I think, and they came under pressure from shareholders after that.
Is that not the share price?
It hasn't knocked the share price, which is very interesting. So as you see here, the gap between, in fact, the reverse probably happened. The share price has been strong and more resilient than we would have anticipated. And I think it's a function of positioning by investors for a more likely corporate event on the horizon. And the reason why a corporate event is more likely now is that the shareholders have got the bit between their teeth. We're not happy. Management know we're not happy. The position of the president chairman is becoming untenable, and his removal would probably make a corporate transaction more likely. And as we know, there's a lot of private equity capital floating around in Tokyo looking for assets. We know that foreign elevator businesses would be interested in Fujitec if they were invited to participate. And other Japanese domestic players would also be interested in partnering with the company. So his removal would make a corporate transaction more likely. And the fact that the pressure is building has led to more event-driven shareholders, should we say, taking a position in anticipation of such an event. So whereas the peer group has suffered in terms of valuation terms in the past 6 to 12 months, primarily due to China continuing to be in lockdown and the impact that's had on the construction market there, and hence their businesses in China, Fujitec, which also has roughly a quarter of its sales in China, has been more resilient than the peer group, I think by virtue of the anticipation around a corporate event.
Okay, that's interesting. There's a question here. Let's have a look at the portfolio if I can find that. I'll go on, wait.
Just went past it, I think.
Which one am I looking for?
Next.
There's a question here about how much of the returns you get are because of what's happening with the underlying companies, and how much is the impact of the improved corporate governance. Is there any way of splitting that out?
Well, this slide is helpful in answering that question. So not only can we look at the total return, but more specifically, one can look at the valuation that existed when we initiated our position compared to the exit multiple. So you could see that a lot of the returns have been generated by buying companies at lower valuations and seeing those valuations re-rate. Now, some of that is a function of our engagement that has led to a better understanding of the value proposition by the market and has led to a re-rating. Some of that is due to a corporate transaction, which generally would occur at a much more realistic valuation than the prevailing valuation. And some of that has been driven by earnings growth. But as you can see here, that in the majority of cases, the contributions have come about from a combination of earnings growth coupled with expansion of multiples. Whereas the ones that haven't worked, a number of these are still in the portfolio, but a number of these are not. You know, there's been we bought companies at very, very low valuations. They had high amounts of cash. We probably overestimated the quality of those businesses, as reflected in the decline in EBIT that we experienced. And even buying them at valuation multiples close to 0, below one times earnings, that hasn't really protected us. And that's why there's been a bit of a shift in the portfolio towards higher quality, higher growth situations where we've given away something in terms of the amount of cash as a potential market cap, but the return on that has been having more earnings growth potential.
Okay, cool, thank you. I think that helps. I'm going to whiz back down again now if I can find it. There's a slide here on the portfolio. There we go. So one of the questions we've got is, what's the overlap between this and AVI? Because AVI was, AGT, the global fund, because that obviously has some Japanese exposure. Is there much of an overlap?
Well, there is an overlap, but the overlap has been going down. So AGT has got, roughly speaking, 19% in Japan at the moment. 3% of that is in Sony, which is not really part of this strategy. It's certainly not in AJOT. So roughly 16% of AGT's portfolio is in names that are in the AJOT portfolio. But the number of names is much smaller in AGT. There's probably half a dozen of these names that you see here in AJOT that we can find in AGT. And that's because AGT is focused on some of the larger, more liquid names. It certainly can't invest in some of the smaller names, market caps around 100, 200 million pounds. And so it's focused on a number of the larger situations here where we are a dominant shareholder and there's an intense engagement process underway. Okay, thank you.
In terms of like sector exposure, is that something that you think about, especially given what's going on with the macroeconomic situation, or is it just a result of what happens with the picking the stocks?
Well, we think about it to an extent, but we don't populate the portfolio by way of targeting specific sectors. So the objective really here is to have a portfolio that's dominated by domestic exposure, not exclusively, but to a large extent. So roughly 2/3 of the portfolio is exposed to more domestic economic situation. Then we want to have a portfolio that's relatively diversified across a number of different sectors. And specifically, we would like to avoid being over-concentrated in any one or two particular sectors. So we're not going to have a dozen companies in the chemical sector, but we might have 1 or 2 companies, for example. It is bottom-up driven by not only the valuations, but the potential we see from engagement in terms of unlocking the value and the specific company fundamentals and the growth prospects. So we won't necessarily be exposed to all sectors in the Japanese economy. We may be slightly more exposed to a couple of situations, but we're pretty agnostic apart from what I've described.
Fair enough. There's a question about T. Hasegawa, but actually maybe before we get there, I'm going to flip all the way back again. Sorry. Okay. This one. Obviously, one of the things that has been notable is the weakness of the yen. So I suppose I was just going to get to articulate exactly what the impacts of that has been on the portfolio, because obviously a lot of Japan is in exporters, which must be benefiting from this.
Okay, so the impact for us at AJOT has been felt in a number of different ways. The most obvious way is we're a sterling-based fund. We don't hedge the currency. And whilst the Japanese market has been fairly resilient in local currency terms, all of that has been given away or given back by virtue of the weak yen when translated back into sterling terms, and the differentiation between sterling-based performance of the Japanese market compared to other global markets is minimal. So we felt the impact on the weakening yen that way. In terms of the operations, there is a sense that a lot of Japanese exporters are beneficiaries of a weak yen, and that continues to be the case, but to a lesser extent than has been true historically. So historically, many of the large Japanese manufacturing companies benefited from a weak yen. They were large exporters. A lot of that, in the case of the large car manufacturers, for example, has been eroded by the fact that they've got much more localized production and there are a greater number of natural hedges in place. But amongst the smaller cap companies, as we show here on the graph, there are still a number of companies that benefit from having a large proportion of their sales overseas without having the localized production. So a number of our companies have benefited, and that's been helpful in outweighing the negative impact of a weak yen that a lot of Japanese companies have faced, and that is rising raw material prices, rising energy costs, and generally in the economy, rising food prices. So, net, I would say it's been helpful, and it's probably enabled Japanese companies on the whole to meet or to even surpass their earnings forecasts, even in a tougher global economic environment.
Good. Okay.
The reason.
Sorry.
I was just going to say that people ask what's going to happen with the yen, and is it going to stay weak? Is it going to continue to weaken? I obviously don't know the answer to that. But what I would say is that foreign exchange markets are notoriously difficult to predict. We understand the reasons why the yen has been weak and why the dollar has been strong. Fundamentally, monetary policy is going in opposite directions. Whilst it may seem that monetary policy in Japan will continue to be stimulatory and will continue to be tightening in the US, we know from experience that that's unlikely to persist forever. And some of the factors that have led to that will start to dissipate, I suspect, in coming months. And the impact of a strong dollar will start to be seen amongst American companies. Japanese companies will be beneficiaries of a weak yen. And so the balance really will start to move probably in favor of a stabilizing yen and potentially a strengthening yen. The yen is very, very cheap on any kind of fundamental metric. It's as cheap as it's been in the last 50 years. And so what has been a headwind to our performance is likely to turn to a tailwind at some point. We don't know precisely when. We know that the current governor of the Bank of Japan, Mr. Kuroda, is due to step down at the end of March, and he has been committed to a very stimulatory monetary policy, and it remains to be seen. It's been quite painful and unpopular recently in Japan. It remains to be seen whether his successor will follow the same path. But it's worth noting that Japan is finally seeing inflation. It's not the kind of inflation that we've seen here, double digits, that we've seen here and in Europe and the US, but they're finally seeing inflation. And whilst initially the inflation that they were seeing was more driven by the raw material prices and food prices and energy prices, which is the bad kind of inflation, there are positive signs now on the wage front. And this is the kind of inflation that they've been desperate to get for the past 20 years, because if people earn more money, then they spend more money, and that drives economic growth. And on that front, the statistics over the last couple of days have pointed to more sustained rise in wages, and that I think would be very positive. And if we continue to see that sustained improvement in the good kind of inflation, that would enable the central bank to take their foot off the accelerator in terms of monetary stimulus, and that would be very positive for the yen.
Yeah, that sounds encouraging. Good. Okay. I skipped over a question, so let's go back in for Hasegawa. So this is your largest investment. And somebody's just saying, what does it do, and what's the attraction that?
Yeah. So Hasegawa is a food and flavorings company. It produces food flavorings that you find in everyday foods. It produces the scent that you could sort of smell in detergents, in air fresheners, bleach, that kind of thing. Its food flavorings go into ice creams, drinks, synthetic meat products that taste like real meat, all those kind of things. Now, the attraction of those businesses is that once your product is in a food product, they tend not to change the taste. So it's a very resilient, attractive industry. And as you can see here, the global peers trade at valuation multiples ranging from 17 up to 30 times. Hasegawa's trades at much less. Again, it's a function of cash on the balance sheet, being relatively small, unknown, but it's a business that has generated very attractive growth, and it's an economically resilient sector of the market. Again, we're a large shareholder. We're not the largest shareholder, but we're a large shareholder. We've got a good relationship with management. We meet them frequently, and they've got in place a newish CEO over the last 3 or 4 years, who's very focused, very capable, very focused on growth, particularly in the US, where they've made a very attractive acquisition. And we think it's a company that will continue to grow its profits and continue to look cheap on valuation grounds, and could be the subject of corporate activity at some point, but that's not necessarily our base case. Be very happy for the company to continue to spend its cash in R&D and generate higher profits for shareholders.
Okay, good. Maybe we should just have a look at the outlook then. So you've alluded to the currency impact. What else should we be looking out for over the coming?
Look, obviously we're going through a correction in global equity markets, and I wouldn't necessarily say that from a global perspective, all equity markets look cheap, but certainly valuations have come down. Where we are in Japan is that certainly amongst our universe, our companies are as cheap as they've ever been. At the same time, from an operational perspective, our companies are generating sales growth. They're dealing with some of the pressures, margin pressures that we see globally, but they're doing quite well. And a lot of companies have been able to maintain margin and pass on higher cost and grow their profits. We've discussed the benefits that a number of companies have seen from the weak yen. And so all in all, Japan continues to be a market that has got good quality companies that are trading cheaply, that are likely to do well in a difficult environment, and starting from a low base, have got a huge amount of potential, re-rating potential. It's a market that also has attracted declining levels of interest from global investors, and those capital outflows have weighed on the stock market. And we know, again, from past experience, that when things turn in Japan, they turn quite quickly. And as that money comes back, it can have quite an outsized impact on the market. So from our perspective, what's not to like about Japan? You've got high quality businesses, attractive valuations, growing their profits, and a host of catalysts to unlock that value. So we're obviously excited about this portfolio, but also in the global context within AVI Global Trust, we're excited about the opportunities that we're seeing in Japan.
Great, thank you. One sort of final question on that sort of, are you using gearing in the fund? Is that something you would do?
Yeah. So I'm not sure if that you can find the slide in there, but historically, we've taken the gearing up to around 10% fairly consistently. It's been, I would say, since launch, it's been somewhere between 5 and 10%. Over the last 6 to 9 months, the gearing's not been utilized to the same extent. We've probably been around about 100% invested. But over the last few weeks, we've become more positive about a number of new situations that we've been adding to the portfolio. And so gearing is back around 3 or 4% at the moment, and I think will continue to creep up towards that 5 to 10% range.
Great. Okay. Well, good luck with everything. Thank you very much for your time this morning.
Thanks, James. Thanks very much for having me again.
Thank you. And we'll obviously follow your progress with great interest, and have you back on next year sometime.
Great. Thank you very much. Thanks, everybody.
Thank you. So we'll just show you the legal disclaimers. as we are obliged to. And then we'll be back next week. I think we had something lined up for next week, and then unfortunately had to pull out. So at the moment, it's just going to be meeting to Andrew Mahati, but I think that's still coming back and worth watching. So we'll have a look at the news, and then Andrew and I will be looking at the events over October, which have been a quite interesting month. And then on the 11th of November, we're talking to Edinburgh Investment Trust, which is an interesting situation too, I think, given that it's had a relatively recent change of manager. So let's see how he's been getting on. And then you can see we've now got events lined up, I think all the way through to Christmas, which is it's scary how quickly that's approaching. So thank you very much for your time today, and we'll be back next week.